Hey everybody, welcome to this free edition of our Trader User Weekly Roundup for the trading week ending November 1st, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is Show Me the Money. We got a lot of earnings that came out this week. And it's been a relatively busy week with particularly the Mag 7. It was a little bit of a mixed bag with them, but let's just kind of dig into what we got for this past week. NASDAQ did reach record intraday highs Wednesday, but it came back down hard on Thursday, closing out the week in the red, as you can see there. Most of the indexes were in the red, with except for the Russell, just barely above flatline. Year to date, everybody's still very strong performance-wise. But like I said in earnings, we got about 42% of the companies reporting this past week Q3 earnings, including 5 of the Mag 7, Meta, Microsoft, Google, Apple, Amazon. But a lot of them were having trouble really moving up a good deal. Some of them moved down, mostly due to CapEx spending. And I think as we move forward in time, that's going to get even harder and harder to justify unless they start showing a return on CapEx spending investment. Just to give you an idea, CapEx spending mostly on AI and infrastructure with Meta is up 36% year over year, and we're talking in the billions. Microsoft CapEx over 79% higher in Q3 this year from Q3 last year. Google up 62% year over year quarter wise. Apple is essentially the only one that's relatively flat. All right. And then, of course, we've got Amazon. They're up 81%. Now, all of them in their earnings are saying they need to spend. So at some point, investors are going to go, okay, we see the spending, but you got to show us an ROI on that expending our investment in capital. So we're seeing some of that starting to rear its ugly head. Okay. Now, a really interesting data factoid came out over the past decade. The S&P has an average annual return of 17%. We have these big moves higher. With in 22, we actually finished down 22%. But even factoring that in over the past 10 years, we've had a 17% annual return because of all the money that's pumped into the economy. Trillions and trillions of dollars, which is now being done by China, by the way. But Goldman came out and said they see an average annual return of 3% over the next decade. Whether it's 3% or 5 or 7, let's just say, and I've been telling our members this in our user group, that we are not going to see this high teens annualized return average over the next decade. It's not going to happen. The Feds are going to be, even though they're cutting rates right now, a lot, I believe, is due to more of a potential return of inflation and then just the high debt load. They got to get these interest rates down so that in the repayment of our debt that we got to borrow to fund the U.S. government, the repayment expense is less. Okay. So I just do believe with all those headwinds in the way, we'll be lucky if we hit 7 or 8% annualized return over the next decade. Okay. Now, meanwhile, this week also we got a lot of data hitting the books. The JOLTS came out, showed that job openings had fallen to 7.44 million in September. It's the lowest level since 2021. Then Wednesday we got ADP. They actually surprised the markets by announcing that their tally of private sector jobs expanded by 233,000. Roughly twice what the markets were expecting. However, on Friday, it came the other way. We got the monthly jobs numbers, nonfarm payrolls. They were essentially unchanged over the month. Employers only adding 12,000 jobs. That's the lowest number since December of 2020, right? Unemployment, though, did stay at 4.1%. And then the other negative that we got was the ISM gauge of manufacturing activity. That declined 7 straight months. It's now at 46.5. That's the lowest level it's been at for 15 months. So there's something underneath the surface that's afoot with the markets, and we have to be careful. I think that's part of the reason with the Goldman Sachs seeing an average return over the next decade of 3%. Now, that's what they're saying, but let's just say it's going to be less than what we've seen over the past decade. We also got weak manufacturing and payroll reports kind of drove the 10-year benchmark yield up to a 4-month intraday high of 4.37%. You can see really it's rounded up to 4.38. You could see that's where we finished for the week, Dividend yield at 1.31%. You can see that the VIX moved up again for this week as well. VIX closed out the week at 21.88. Last week it was at 20.37. So we're continuing to slowly move VIX higher because of what we got coming up. We got the Feds next week. Now, normally the Feds are on Wednesday, but because we got the big election on Tuesday, the Feds are going to delay by a day, and we'll get the Feds on Thursday. Okay. Also, one other thing happening this weekend, don't forget, for most of you folks here in the U.S., it's a little bit different across Europe. Set your clocks back an hour. We fall back into, we give up daylight savings time Saturday night or Sunday morning at 2 a.m. Okay. So that's a little bit about what we've got here in the U.S. And then, of course, if we go over to the Eurozone, you can see, much like the U.S., about the only one in the green was the Nikkei, and that was just barely up like the Russell in the U.S. Everybody was in the red for the week. We did see the Eurozone economy expanded in Q3 by 40%, or 40 basis points rather, sequentially, double its second quarter growth rate. The consensus was only 20 basis points, so it doubled the consensus. And we also saw that Germany, unexpectedly, believe it or not, avoided a recession by growing 20 basis points. If they'd have finished in the red, they would have been in an official recession. Now they're close to it, but they officially avoided the definition of a recession. Meanwhile, headline inflation moved up just a little bit in Europe. It moved up to 2%. The prior month it was at 1.7. So I think inflation globally, not just in Europe, but here and globally, is going to be very sticky. All right. We got services inflation steady at 3.9% across Europe, and core inflation came in at 2.7 across Europe. You could see everybody in the red across Europe. The only one year to date in the red was the CAC 40, down 1.78% year to date. Okay. Now, if we go over to the Asian markets, you can see Japan. The yen initially weakened a little bit against the U.S. dollar on the election outcome in Japan now, not the U.S. Most of that was due to expectations that a period of political uncertainty in Japan is going to kind of move forward, impacting the fiscal policy of the Bank of Japan, right? But it's that October meeting, the Bank of Japan held their policy rate steady at 25 bips, 25 basis points. Remember, their big goal was getting out of the negative interest rate, which they've been in for a long time. And the yield on the 10-year Japanese government bond pretty much stayed unchanged for the week at about 95 basis points. And of course, if we look at China, both China and Hang Seng, they were in the red for the week. You can see China just slightly up. Well, actually, just slightly under 10% for the year. We did see that China's factory activity expanded for the first time since April of this year, right? A little bit better demand. The official manufacturing index, the PMI there, came in at actually 50.1. So understand, anything below 50 is a contraction, above 50 is expansion. So let's just say it's flat right now, but it's better than what it was in 49 and 48, 47 in prior months. So it's slowly consolidating there. And meanwhile, their non-manufacturing PMI, that came in at 50.2. So essentially the economy there in Japan is roughly flat, right? The one bit of good news that shows China is starting to consolidate and possibly move up in 2025 is the value of new homes across the country's top 100 developers actually rose a little over 7%, 7.1%. Okay. Remember, last month it was down 37.7%. So this is marking the first year-over-year growth from this year to last year in 2024. First time. So really, if you put all this data together in China, you know, the first batch of major economic indicators after rolling out their huge monetary stimulus package, is just like I said, just shows early signs of kind of stabilization, a little bit of recovery in China. So 2025 should be a little bit more about the recovery in China, as these past 2 years have just been moving lower in stabilization. Okay. If we come over, let me just switch over and take a look at the charts here. Let's get it over to the E-mini S&P 500 futures. We'll start there first. It'll take a couple of seconds to come up on the screen. But what you're going to see here is the E-mini S&P 500 futures. You could see here where, and let me just point out a couple of technical things on the chart here. You can see that the 50 EMA is sitting at 57.51. We closed at 57.59. We actually closed below the 50 EMA on that hard down day on Thursday and moved back up above and regained it on Friday. And you can see my potential pullback points. We hit them nicely so far. All right. So now, if I were to let my system calculate where can we go upside wise, right? I'm going to come over here. And it's suggesting that we can run up through the, let's just say through December of around 59.75, 59 to 6,000, 59.75 to 6,000 through the end of the year. So obviously, any misstep by the Feds, or depending on how the U.S. election turns out, that can change the direction of this markets. But as I've been telling our members, expect a dip. And my expectation, I think I mentioned it here to you guys on our weekly roundup, was anywhere from 3 to 6%. And I said I could easily see it coming down to the 5650, 5660 area, down to 5600, kind of closing that gap right there. I could see that happening. And we're not out of the woods yet, okay? Because we do have the Feds next week, again on Thursday, not Wednesday, and we do have the U.S. election. And it could create a lot of turmoil. I don't know how this thing's going to shake out. But speculation is if Trump wins, the markets are going up. If Kamala Harris wins, the markets are going down. So it's not a bet that I want to play right now. So let's just see how things shake out. Although the chart, regardless of what is external factors affecting price, the chart and technical action is just what the chart sees, is suggesting upside, anywhere from 5,900 to 6,000 by the end of the year. Okay, that's what the chart's showing. And of course, if we come in and look at the Dow, you can see the Dow also below the 50 EMA, move back up above here like that. Now this is an Elliott Wave 5 for the Dow. You can see we did have the trigger back on October 21st to go short the Dow. Really nice signal. And now we're regaining. So can the 50 EMA hold across the Dow and the S&P? That's going to be very important. And let's see where we open on Monday going into the election on Tuesday. Remember, for the Feds, there's almost a 99% chance they're going to cut rates by 25 bips, which is a quarter of a point on Thursday. But it all depends on what Boom Powell says at his press conference at 2:30 p.m. Eastern Standard Time, is where he's going to drive the markets, because the markets have already built in a 25 basis point rate cut. Markets have also built in a 25 basis point rate cut for December. So if words coming out of his mouth indicate that that could be a question mark in December, another rate cut, you could see the markets react negatively to it and sell off. So these are some of the things that we've got to watch very closely, okay? If we look at the NASDAQ 100 futures, which we had all the mega, or 6 of the 7 mega cap earnings coming out, or 5 of the Mag 7 coming out, you can see that we held the 50 EMA nicely, right? This is NASDAQ 100 futures, okay? Did not make new highs. In fact, the last all-time high in the NASDAQ 100 was on July the 12th, primarily because the Mag 7 have been, playing catch up for the past couple of months. They have not been that strong. I think there's still worry over the CapEx spending. All right. Most of these Mag 7 stocks are spending, in the multiples of billions every quarter to build out new data centers, and to try and meet the demand of AI. And Facebook, or Meta, has over 100,000 of the high-end NVIDIA chips, those that are $35,000 to $40,000. Now, I doubt they paid retail, but whatever they paid, it was in the billions. 100,000 chips in their farms, all right? And they want to buy more. So, and NVIDIA is like a gun runner. It doesn't matter who wins and who loses, they're selling the chip. So, and their earnings don't come out for another couple of weeks on November the 20th. So we're going to have to wait for that. But anyway, you could see it's holding the 50 EMA. So the 50 EMA this week is going to be really crucial for the markets. Okay. And then if we go to the lone survivor this week that actually moved up a little bit, that would be the Russell. Let me see if I can find that sucker on here. Here we go, right here. The Russell just barely in the green for the week. You could see here it also fell below the 50 and then regained the 50. So every single major index in the US is just barely holding the 50 EMA. So that's going to make it crucial going into the election next week. Can the 50 EMA hold? And if it does, are we going to get a little bit of a lift off based on the Feds and the elections coming up? Okay. So that's a little bit about what I'm seeing there. And of course, if we come in and we look at the VIX is slowly edging up higher, right? I mean, you can see here, the VIX, we hit a low point the end of September, and then we had a little bit of a sell-off here into early October, and a little bit of a head fake, and then right back up again. So we're at a key level. You can see at this level right here, we've had a hard time getting over that level in the VIX, right? Let me just blow it up so you can see a little bit better here. And we're still in the light red color, so there's kind of a danger zone. But we're in that level right here where we hit highs, highs, and highs. So kind of a triple top here. Last time we took that out was that big Japanese yen carry trade debacle on August 5th when volatility actually intraday went up to 64. I don't see that this time, obviously, but I do see that should the Feds disappoint the election goes Kamala's way, then I think the odds of going lower in the markets and hence higher in VIX are much greater. Okay. If we look at the front skew, right? That would be the VIX and the November vol futures. Notice we're in the red. That shows we're in a backwardation environment right now. And if we look at the back month skew, that would compare November and December volatility futures. We're even deeper in the red. So the skew is even more backward going out through December. Okay. That just shows there's a lot of fear in the market right now on the potential move lower through the end of this year. Okay. And then, of course, if I go way out in time and I compare the December and June volatility futures, kind of known as the 2-8 spread, you can see here that we're getting close to red, but we're in the green just barely. Now, if you go backwardation in this, that means it's going to get really ugly. All right. That's generally when you get the VIX over 25 to approach 30, when you're in a backwardation out 6 or 7 months. All right. But we're in backwardation through January this year, so we've got to watch very closely. Next week's going to be a make or break, I think, for the market. If we look at the bond market, the other thing that's hurting the markets is interest rates keep moving higher. Look at bonds. We're moving lower and lower, and when bonds move lower, interest rates move higher. Right? And a lot of people are trying to figure out why are rates going higher. I believe it's a very simple explanation. People are saying, well, heck, the Feds are cutting rates. They cut 50 basis points. They're going to cut another 25 next week. And the odds favor another 25 by December. That'd be a full 1% cut. Yet the 10-year and the 30-year interest rates are moving higher. Well, remember, the further out in time you go, the more these interest rates reflect the future economy. And also the potential for inflation and deficit spending. And I think all of those are wrapped in. And don't ask me which one carries more weight, because I think it varies week to week. But we've got to finance a little over $1.5 trillion over the next 6 months in the debt market. The U.S. does. Now, I don't know if the markets are slowing down. You think that the investors that are buying the U.S. debt are going to settle at the current rates? Or you think they're going to want to be paid a little bit more to take on U.S. Treasuries? My guess is they're going to want to be paid a little bit more, i.e. higher rates. So the Feds are going to be fighting that, I believe. So that's a little bit about what I'm seeing here in the bond market, the interest rate market. And of course, if we come over here and look at currencies, they're going to be affected big time by the election. All right, big time. If we look at the dollar, naturally it's stronger because the rates are stronger. The dollar just blasted up, right? It's going to probably peel back and test the 200 EMA. The 50 EMA is moving back up to cross the 200 EMA. But the dollar has been strong because we're the only country where the rates seem to be going back up. If we look at the euro, you're going to see the euro is doing just the opposite, right? it's having a hard time getting over the 200 EMA. Now, longer term, we're going to want to be long the euro, but not right now. This Elliott wave 3 suggests any rally is going to be sold off, which means we can go lower in the euro, higher in the dollar. Next week, we're going to get a lot of movement on these currencies. And then, of course, if we look at the yen, you can see here with the yen, we got long back over here and we got out either at this get out point here or this get out point here. Made good money on the yen and now it's coming back down again. I think it's going to go even lower in the near term. Further out in time, I think the yen is going to go higher. So we're going to wait for a good entry point to go long the yen, but I think it may go a little bit lower. So let's just give it a little bit of time and see how it plays out. Then, of course, if we go look at gold, one of the main reasons why it's much higher, you can see gold made new highs here on the October the 30th, the last day of October, up 35.23%, right, a little over 2,800, and then it's backing off. I think it's going to come back down a little bit lower and settle in and then move up a little bit. All right, gold is up for fear of the U.S. deficit and as a hedge against the markets, right? So it's going to be real interesting to see how gold plays itself out. And of course, if we look at silver, same thing, same scenario. It moved up, made new all-time highs on, in this case, October 22nd. It's up almost 46%. And for those that I told our members for our weekend update, weekly roundup, I told our members we had a pair trade where I suggested you go long silver and short gold. And this was way back over here in the summer months, and it turned out to be a great trade. Silver on a percentage basis relative to gold outperformed dramatically, and it just shot up. And now silver is ahead of gold year to date. Before, silver was flat to slightly, not down, but just it wasn't doing very well. Gold was up near its all-time highs, and it made for a good reversal trade or a pair trade, long silver, short gold. And then, of course, if we come down here and look at energy, you can see oil basically flat on Friday. But if Trump wins, oil is going to go lower because he wants to pump, baby, pump. He wants to drill, baby, drill. Just drive the price of oil down. Okay, and that is a prescription for lower oil prices for sure. If Kamala wins, you're going to see oil go up. Now, some of that fear premium built into the oil market because of Israel and Iran fell out of bed when they kind of, I don't know if either side's going to attack each other again, although Iran is saying they will. But if they do, then it's going to drive oil up. But that's just a near-term phenomenon. Longer term, I think oil is going to drift lower. Okay. And then, of course, if we look at nat gas, it's going to eventually go in the same way. You can see here, this is just a switch over to a new contract, but I think nat gas is going to come back down and settle in down here. I'd like to see it go a little bit lower. We got long nat gas right over here, right? This was a low-hanging fruit trade and rode it all the way up. Right now, I think nat gas shouldn't be this high. That would be, to me, worth it for a short, right, in the natural gas. Now, keep in mind, if Iran attacks Israel and then Israel goes back into Iran and starts taking out some of their oil facilities, this stuff's going to go batshit crazy to the upside. So that's the risk of the trade right now. Okay. But I do see it left undone without any external geopolitical push one way or the other. I see nat gas and oil coming back down. All right, everybody, that's a really quick update for this weekly roundup. Again, set your clocks back an hour on Saturday at 2 a.m. in the morning for most of you guys. Otherwise, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao now.